Hey everyone, this is Mrs. Contos, and I am here to tell you a little bit about the differences between stocks, bonds, and mutual funds today. So, you might be wondering, well, what is a stock anyway? A stock is basically when you purchase a share of ownership in a company. So, you'll see here we have a picture of a certificate of stock for Starbucks Corporation. So, we're going to go through what the main differences are with how do you actually look at why you would purchase stocks and how do they relate to bonds and mutual funds. Okay, so obviously people are going to invest in stocks because they want to make money. So you can go to the stock market or a brokerage firm and you can buy shares of stock, and you have to decide how much stock you can afford and how much you're interested in based on the companies. And you can buy stock in multiple different companies. Every time you buy stock, you are basically giving money to that company through your purchase, and they are able to use that money for whatever they need. So, one of the things that you have to look at, and I'm going to go ahead and take this off here, is your stock market quote. So if we wanted to buy stock in Starbucks Corporation, I might look at Yahoo Finance or Google Finance, and I can see, hey, you know what? Starbucks Corporation currently costs $99.56 for each share. So if I were to buy 10 shares, it would cost me $995.60. I can see their ticker symbol, so I can search that on any financial website or app. And I can also see how much the price has gone up or down. And I can look and see over different lengths of time, how has their stock changed. So we can see that, it was a little bit lower, and now it's gone up again. And in real time, you would see this jumping up and down to show what's actually happening. Okay, if I come back to this information. So once you purchase your stocks, you've paid your money. Now, how do you actually get money back? So, two ways. If you have preferred stock, or you have stock that guarantees dividends, you can receive dividends, which is a share in the profits from that company. So if the company is profitable, you might get some money. So for this one, if you bought one share of Starbucks, you might get about $1 for every share that you purchased every year. So not a whole lot, but different stocks do have better dividends, and those can often be paid out as checks or direct deposits into your bank accounts. And then selling a share. So if you notice that, hey, the price really went up and I could make some money, you can turn around and sell your shares. And when you do that, you earn capital gains, which is the money made off of making a profit when you sell something. But there are risks. The stock market, as you know, goes up and down. It's kind of like a roller coaster. So we call that volatility. And the price could go down and maybe never come back up, which means you'll never be able to sell it for a profit. And it is really impossible to know when is the best time to buy and sell. If anybody ever tells you that they know when to buy and sell stocks, they are lying to you, and you should walk the other direction. Okay, so that's stocks. And then bonds. So bonds are basically, you purchase a bond, but when you purchase that, you are basically promising that company that you will loan them that money that you spent. So you purchased a bond for $1,000. That means that you paid $1,000 to this company, in this situation, PepsiCo, or it could be to the government, which is usually a more secure bond. And they are allowed to use that money for whatever they need. They will keep that money for a set amount of time. For this one, we're going to use a term length of 10 years for our example, and they will pay you back interest. Often interest is paid at a regular interval, maybe quarterly or twice a year. And so that means that this is kind of considered an income investment, and it's also a lower risk investment. You make money by earning the interest. Generally, they're going to pay you out that interest. And so you can kind of count on that as income as long as that company or government is doing well. And then at the end of the term, so at the end of your 10 years or however long the bond is for, you will get your money back along with any final interest. Now, the risk, and I know this is, you can't really quite see this, but the risk is called default because maybe the company is going to fold or not be able to pay you back. That's called a default risk. The other risk is inflation because often the interest rates are lower. This is considered a lower risk type of investment. But you do also want to look at the specific bonds, look at their ratings. Different bonds are considered better rated. If you purchase a junk bonds are poorly rated and they are much higher risk. Okay, so differences between these. Stocks are definitely riskier, bonds generally not as much. Sometimes people use stocks as a quicker turnaround, whereas bonds are a longer term investment. And to minimize risk, you can invest in shares of multiple companies. Don't put all your money into just one company, or you can purchase both stocks and bonds. All right. This is just a quick overview of how the more you vary stocks and bonds, the more it averages out your risk. Stocks generally earn better returns, but because of that, they also have a lot more volatility versus a bond, which doesn't earn as much, but also has a lot less volatility. So you kind of want to average it out. All right, this would be an example. I'm going to talk about mutual funds. A mutual fund would be, let's say that you decide to hire somebody who's going to invest your money, and they're going to collect money from a whole bunch of different people, and they're going to pool all that money together, and they're going to invest in a whole bunch of different companies. And so these are a whole bunch of companies that are on the stock market, and you can see exactly how they're kind of trading. Are they doing well? Are they doing poorly? And so your manager is going to take your money along with the money of all these other people. They're going to decide where to invest, which shares to buy, which shares to sell. And because you're trusting them to do that, you're also going to be charged a fee. So you're going to pay them a fee. And you might be wondering, well, why in the world would I want to invest with somebody else making all the choices? Well, mutual funds have less risk than choosing stocks by yourself because this manager is constantly looking at what's happening in the stock market. So they are going to be trying to make you the most money possible. They also are going to be better able to access information than you would as an individual investor because they are dealing with millions of dollars versus you probably are investing hundreds, maybe thousands. And then the last thing that you need to know about mutual funds right now is just that this is a way to average out the risk, and it also will average out your returns. So people invest in mutual funds because they can invest their money over a very long time. So at least 10 years, usually more like 20 or 30 years, you put the money, you just continue to invest, and the manager will continue to buy and share, and they will hopefully earn you a pretty good return on your investment. And that's basically what I wanted you to know in a nutshell about these three different types of investments.